In mid-2005, Howard Marks had no idea that the US housing market was propped up by millions of bad mortgages and was being fueled by degenerate Wall Street gambling. But despite not knowing exactly what was coming, he began selling large amounts of assets within his investment fund, which led him to profit considerably from the ultimate fallout of the 2008 financial crisis. And in March of 2020, during the COVID-sparked market panic, he was investing heavily despite admitting that he had no idea how bad the virus would ultimately be. So how does Howard Marks make money every time the market shifts, despite not knowing exactly what is going to happen next? Howard Marks' first big prediction began in the fall of 1999. Financial markets were booming and the gains were led by a basket of mostly new technology companies that had sprouted out of the internet revolution. It seemed like it was the easiest place to make money. There were new companies being launched on stock exchanges every single day, and even though most of them had no profits or even no revenues in some cases, money from Wall Street and retail investors was flowing freely and stocks were going up and up and up. For anyone who has an understanding of financial markets, this was pretty clearly a market bubble. Howard Marks describes a bubble as an irrationally elevated opinion of an asset or a sector. And that's exactly what he saw in the tech sector of the US economy. In January of 2000, he wrote, "I find the evidence of an overheated speculative market in technology, internet, and telecommunications stocks overwhelming, as are the similarities to past manias. To say technology, internet, and telecommunications stocks are too high and about to decline is comparable today to standing in front of a freight train. To say they have benefited from a boom of colossal proportions and should be examined very skeptically is something I feel I owe to you." Just 2 months later, in March of 2000, the Nasdaq stock exchange that traded most of the speculative tech sector began to fall, only reaching a bottom in October of 2002 after declining almost 80%. But it was only a few years later that Marks would make his next big prediction. Beginning in late 2004, Marks described what he saw coming as a slow developing train wreck. After the internet bubble burst in 2000, the aftershock was so significant that the entire US economy fell into recession for most of 2001. In an effort to jumpstart the economy, the Federal Reserve had lowered interest rates from 6.5% in 2000 to just 1% in 2004. This effectively lowered the returns that investors would expect out of all types of asset classes. Unfortunately, it's not in human nature to simply accept that returns are not as good as they used to be. Instead, investors sought to maintain their returns by simply taking more and more risk. In his 2004 memo titled "Risk and Return Today," Marks wrote, A. Prospective returns on most asset classes were unusually low, and B. Risk-seeking on the part of investors looking to improve on those low returns had led them to embrace higher risk and alternative investments. Just a few months later, in 2005, he wrote another memo about how investors were finding these higher risk investments in residential real estate. He wrote about the tendency of investors to A. Ignore the lessons of the past cycles, B. Fall for new developments, and C. Pile into risky investments guided by the time-honored platitudes such as, "It's just different this time. Higher risk means higher returns." Or, "If it stops working, I'll just get out." While self-admittedly he had no idea how bad the bubble was in residential real estate, he did see rampant speculation across financial markets and accordingly sold large amounts of assets, liquidated funds, and limited the new investments he was willing to make through his fund. He followed up his concern that something big was coming in one of his 2007 memos. "Where do we stand in the cycle? In my opinion, there's little mystery. I see low levels of skepticism, fear, and risk aversion. Most people are willing to undertake risky investments, often because the promised returns from traditional, safe investments seem so meager. This is true even though the lack of interest in safe investments and acceptance of risky investments have rendered the slope of the risk-return line quite flat. Risk premiums are generally the skimpiest I've ever seen, but few people are responding by refusing to accept incremental risk." Just 8 months later, Bear Stearns collapse, which you might remember from this scene in The Big Short.
Mr. Miller, I'm sorry, quick question. From the time you guys started talking, Bear Stearns stock has fallen more than 38%. Would you still buy more?
Yeah, sure. Of course I'd buy more. Why not? Boom!
The US stock market fell 53%, and the world entered the worst economic crisis since the Great Depression. But it's what Howard Marks did next, which is largely responsible for the more than $2 billion net worth that he has today. Just before I get to that, if you want to learn more about the global financial crisis or a wide variety of topics related to finance, economics, or even other areas of study, then I highly recommend you check out the sponsor of today's video, Shortform. Shortform provides super in-depth summaries of each book's key points and concepts, and goes above and beyond by building on the top ideas in their book guides. They cover a great range of genres, including books on economics, productivity, and finance. Personally, I like using Shortform to revisit books I've previously read, such as Tools of Titans, which I read a few years ago, and also to get the key ideas of new books to decide whether or not I want to invest in reading the full book. Also, the Shortform browser extension is their newest innovation included in their main service. With it, you can get detailed summaries of blogs, articles, emails, and even YouTube videos in a single click. And just like the Shortform book guides, you'll get added context, counter-arguments, and even resources to help you gain a fuller understanding of each topic. This is something I've never seen before, and it's actually incredibly useful for someone like me who does a lot of research and reading articles online. You can get limited accessibility of the extension completely free, but Shortform subscribers can use its full range of capabilities. To get a free trial and an additional 25% discount on the annual subscription, join Shortform through my link shortform.com/hodder, or scan the QR code, or click the link in the description. In late 2008, the fourth largest investment bank in the world, Lehman Brothers, collapsed, and the world had entered a complete financial meltdown. In fact, it got so bad that many people really believed that the US financial system was going to be completely destroyed, and that this was the beginning of a 1930s-style depression that would last for years, if not decades. So the situation posed a very difficult question for investors: to invest heavily now, or to wait for things to get better? This is what Marks wrote at the time. I think the outlook has to be viewed as binary. Will the world end or won't it? If you can't say yes, you have to say no and act accordingly. In particular, saying it will end will lead to inaction, while saying it's not going to will permit us to do the things that we've always done that have always worked in the past. We will invest on the assumption that it will go on, that companies will make money, that they'll have value, and that buying claims on them at low prices will work in the long run. What alternative is there? Either the world was going to effectively end and whatever decisions made were irrelevant, or the financial system would continue to work, and therefore those who bet on it would come out on top. On the basis of this rationale, Marks invested a total of $7.5 billion for clients in late 2008, at a time when almost nobody was doing the same. What made the situation interesting was the overwhelming amount of pessimism about the future of the US financial system essentially eliminated almost all the downside of investing in stocks. And the utter distrust for the financial markets lasted for an extremely long period of time. By 2011, investors who participated since the year 2000 had pretty much made no returns. And the consensus at the time was that the stock market was just no longer a good place to invest. This led in 2012 to Marks' next big prediction. The markets in 2012 reminded him of an article that he read in 1979 called The Death of Equities. The Businessweek article was written during a time of raging inflation, recession, and long stretches of bad stock market returns. And the article's premise was essentially that nobody was going to invest in stocks ever again. Whatever caused it, the institutionalization of inflation, along with structural changes in communications and psychology, have killed the US equity market for millions of investors. For investors, low stock prices remain a disincentive to buy. For better or for worse, then, the US economy probably has to regard the death of equities as a near permanent condition, reversible someday, but not soon. It would take a sustained bull market for a couple of years to attract broad-based investor interest and restore confidence. And the article couldn't have been more wrong. In the 21 years from 1979 to 1999, the stock market returned 17.9% per year, one of the best periods for stock returns in US history. To Howard Marks, the 1979 article perfectly demonstrates the difference between the average investor and second-level thinking. The average investor sees negative economic indicators of the recent past and extrapolates them into the future, whereas the person who applies rationale could see that stock prices pushed down by pessimism is exactly the conditions that lead to strong future performance. To Marx, 2012 looked exactly the same as 1979, and well, performance was about to be the same as well. From 2012 to 2021, stock market returns averaged 16.5% per year. Once again, excessively negative sentiment had resulted in major gains. And that simple but important notion would set the stage for Howard Marks' final big prediction. It was March of 2020. News of the coronavirus becoming a global pandemic was spreading, and the stock market collapsed over 30% in just a few weeks. Nobody knew what was going to happen next, but same as situations in the past, not knowing what comes next isn't a good enough reason to just sit out and not participate in financial markets. In his letter to his investors during March of 2020, Marx wrote, "The bottom is the day before the recovery begins. Thus, it's absolutely impossible to know when the bottom has been reached. Ever. Even though there's no way to say the bottom is at hand, the conditions that make bargains available certainly are materializing. Given the price drops and selling we've seen so far, I believe this is a good time to start investing." Once again, the overwhelmingly negative opinion of stocks had created the exact conditions that are good for investors. A market where good assets are selling for extremely low prices. So it didn't matter that you didn't know whether things were going to get worse. You were essentially already able to buy incredibly good assets or incredibly good businesses at really good prices. Throughout the 5 predictions that Marx has made, some of the strategies or principles may have become clearer to you, but here's a summary of how he does it. The first thing to remember is that the best way to learn about future events is to study when those events have happened in the past. A, what happened? B, is there a pattern that has been repeated? And C, what are the lessons to be learned from this pattern? But the most important principle to understand is that most of the time, you cannot at all predict what is going to happen. Most of the time, stocks are slightly overvalued or slightly undervalued, or the market is slightly more risky or slightly more favorable. At these times, no prediction you could make would have any level of certainty. It's only in rare moments of extreme pessimism or optimism that you can say with reasonable confidence that markets or an individual stock is likely to swing in the other way. And this is actually exactly why value investors demand such a large margin of safety. You only invest in stocks where the price is far below its real value, because only in those circumstances can you actually be confident that the price revision is going to work in your favor. Mark's other important lesson is that readily available quantitative data regarding the past and present can't hold the secret to superior performance since it's available to everyone. Where you have an edge is in better understanding the difference between how things are supposed to work and how they actually work in the real world. Fundamentally, this has to do with investor psychology. How do investors actually behave in financial markets? Because a lot of the time, investor behavior is completely irrational. A quick reminder to check out Shortform, get your free trial and an additional 25% off an annual subscription if you use my link shortform.com/hodder or scan the QR code or click the link in the description.